Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This is going to be a very special episode. We're going to be talking about the long-term picture for the stock market, the long-term picture for the financial markets, and we're going to be using one of the most powerful macro tools that exists, which is the Dow to gold ratio. It's the ratio between the Dow Jones Industrial Average and gold. We're going to be going into detail into what's happening on this ratio, what it can tell us about the future performance of the stock market and gold, and what we can do about it. We post these videos multiple times a week if you're interested in following these crazy markets with us, jumping into the charts, short term, intermediate term, and looking at the broader macro and long-term picture. Make sure to subscribe to the channel. And now, without further ado, let's get right into it. All right, so the Dow to gold ratio, this is a chart that goes back to the 1900s. It shows you periods where you have the stock market outperform all the way till 1929. Then you have periods where gold outperforms, periods where stocks outperformed 1940s and 1950s. And so it really gives you those risk off periods in the market and risk on periods. And, there's cycles, very short-term cycles in trading, right, where you have sector rotations week by week, but you also have much longer-term cycles that are visible on this chart, where you have speculative assets that perform well and then more safety assets that perform better, right? If we take a look at the SP 500 throughout history, it's quite easy to see the periods where it underperforms, right? Between 1929 and 1947, 1960s, during the 1970s here, and between 2000 and 2010. And those periods also happen to be periods where gold does well, right? This period here, gold did well, and this period here, gold did well. So now that you've understood the concept behind the Dow to gold ratio, let's quickly apply some technicals on this chart, because I do have an interesting thing to show you here, and that's hopefully gonna raise some eyebrows on this video. We have a nice, beautiful trend line here capturing quite a few reactions since 2000, and we can take it all the way back to this reaction low to capture that 2011 low on the Dow to gold ratio. And why am I doing that? Because if we zoom out on this chart, you can see we have other reactions. And I love when that happens, because that tells me I've just drawn a price channel that the market is looking at, right? We have all of these nice reactions. It even had a nice little reaction here. And then the market's created that same channel for this cycle here. So what does that exactly mean? Does that mean that we're going to be rejected here and stocks are about to crash and gold is about to go parabolic? No. Unfortunately, the financial markets are not that simple. I wish they were. But first of all, just because the ratio is moving down, let's say if we do get rejected here, it doesn't necessarily mean that stocks are going down. It could just mean that gold is moving up. And I'm going to show you examples of that. This 2003 to 2006 period here, the ratio was moving down, but let's see what the SP 500 was doing. It was in a big bull run throughout this period. That was a 3 to 4 year period where stocks were performing well, but gold was performing better. You can say the same thing about this 2009 to 2011 period. The ratio was just absolutely crashing down, but stocks were performing well. And that brings us to an interesting concept in trading and investing and technical analysis, is that fundamentals and macro will ultimately drive the technical. And it doesn't work the other way around. So if you've been watching our videos, you'll know that we have a strong bullish outlook on the market right now. We have strong revenue and earnings growth, strong service PMI numbers. We have government bond yields that are deeply negative here, with a 10-year yield staying in negative territory. That makes bonds extremely unattractive and it pushes stocks higher. So we're still in that risk on environment that we've been in since March 2020. Now we can speculate on what would have happened if we didn't have a pandemic and if they didn't artificially rescue the economy from a depression and created that risk-on move in the markets. Perhaps we would have seen markets go down and gold go up. But right now we're still in a risk-on move. But we are watching this chart very carefully. Why is that? Because if we get rejected, it might mean that it's gold's time to shine as well. And it might mean that we're going to see both gold and stocks going up, but gold maybe even more quickly than the stock market. But if we get a big breakout here, that's the market telling us that we're still risk on and that gold is just unattractive here with such a strong environment for the stock market. Now, don't get me wrong. We're not in the camp that thinks that the S&P 500 is in this wonderful brand new bull run and that millennials are going to drive this 20-year bull run just like the boomers did. That's not at all what we think is going to be happening. This is a post that we made on Twitter a while back. It shows you the stock market allocation compared to the S&P 500 10-year return. So that blue line here shows you the 10-year return. So it stops in 2011 here. Why is that? Because we're in 2021. So if we want to have the 10-year return of the stock market of 2012, then we'll have to wait till we're in 2022 to know how far up stocks went. That's why we have this delay of the 10-year return. But that's not where this chart is interesting. It's interesting because we have the stock allocation as well. And it shows you that the 10-year return of the S&P 500 follows stock market allocation, right? So how much investors are allocated to equities versus bonds versus real estate versus other assets. That's currently just above 50%, similar to the dot-com bubble. And it shows you what kind of returns you can expect in the next 10 years by investing in an environment where stock market allocation is at 50%. And the answer is that your 10-year return is going to be negative. So I made a little joke here saying that our end of year target for 2032 was 4,500 points. So a few percentage points below where we currently are. That might actually not be that much of a joke. So do not be fooled into thinking that the next 10 years in the stock market is going to look exactly like the last 10 years. That has never happened before. Investors who are putting their money into passive equity funds like the S&P 500 are very likely to endure a lot of volatility in the next few years. And that's coming from someone who loves to make bullish cases, right? We're extremely bullish on gold, extremely bullish on cryptocurrencies. We absolutely love that sector. I wish I could be bullish on stocks, but the data just does not support that. So similar to the late 1990s and similar to the late 1960s or even the late 1920s, I think it's a very good time right now to learn how the financial markets work, learn how macroeconomics work, learn what influences asset prices. There's an abundance of information online. There's so much to learn, so much easy access to information. Whether you do that with our service or not, that doesn't matter as long as you go through that process. Our ultimate goal is to inform as many people as possible and to get individual investors, especially young investors, going into a financial education journey. I'm already extremely happy that you're watching our videos on YouTube or following us on Twitter. If you do want to take it one step further with us, getting you guys to learn about the financial markets, learn how to protect your capital, learn to find big opportunities in the current market environment. That's one of our core objectives at Game of Trades. We have a big investment tab where we talk about our entire strategy, our investment opportunities, when we have buying opportunities, and most importantly, why we make the decisions that we make so that you can objectively reflect on those decisions with the data that we provide. Our service is extremely cheap compared to any comparable service, right? Financial education and especially convictions are often extremely expensive online. We've deliberately decided to keep the prices low. to give access to as many people as possible. So again, if you're interested, check out the free trial. It doesn't cost you anything to just take a look at our articles, and it really helps our business out and lets us explore new projects, new ideas that we have for expanding our service, for expanding and making our service better. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to smash that subscribe button. Now, in the meantime, I wish you good luck on your trading and see you next time.